Yeah, we back. Welcome to week 2 of Whiteboard Wednesdays. Today we're going to be talking about investment accounts, types of brokerages, and the use cases for each of them. All I ask from y'all is that y'all drop a like on this video, subscribe to the channel, and share this video with somebody that y'all want to see win in life. I'm not going to waste your time, so let's get right into it. A couple of topics we'll be talking about today are first, retirement accounts. There are two main types, but there are also a third type that most people might not know about, so I'm going to put y'all onto that today. Next, we're going to be talking about taxable accounts. Then we're going to be going into different types of brokerages and what each one is best for, right? So let's get right into it. Starting off with retirement accounts. As I said, there are two main types. So I'm going to do a little chart and we're going to compare and contrast the two and talk about the pros and cons of each. So as y'all might be familiar, the two main types of retirement accounts are 401ks and the other is a Roth IRA, right? So these are the two main types of retirement accounts. They each have their own pros and cons of each. And at the end, we're going to be talking about which one is best for you to own if you have to choose one. Personally, I would just say that you should own both of them, but I'm going to tell you at what point each one becomes the most beneficial, right? So first off, the biggest difference between the two is that they have different contribution limits, meaning each one has a cap on how much you can add to it each year. So a 401k has a larger limit. It has $23,000 limit. So you can add up to $23,000 to your 401k every single year, right? Roth IRAs have a much smaller limit of $7,000. So you can only add up to $7,000 to your Roth IRA per year. There's a reason why the Roth IRA has a much lower limit, which leads us to the next difference between the two, is that 401ks are tax deferred, right? Tax deferred means that the money that you put into your 401k is not taxed yet, right? So it comes straight out of your paycheck before Social Security, before Medicare, and all that stuff comes out of your contributions. It goes straight into your 401k. It doesn't get taxed until you retire, and then you start taking that money out, right? Roth IRAs are different because they have tax-free growth. I'm going to add growth right here. So basically, your Roth IRA, the money is taxed before it goes into your account. So after Medicare, after Social Security, after all that stuff comes out, then you can take some of that money and put it into your Roth IRA, right? Now, tax-free is better. Reason being, right? So let's say let's say at year 5, right? You have, say, $25,000 in your 401k, right? And over the next 20 years, that grows to $1 million, right? Once you start taking from that $1 million, then you get taxed. You're going to be taxed a lot more on $1 million than you would have been taxed on 20,000, right? So it's a lot better to have your money taxed when it's smaller than when it gets larger, which is why Roth IRAs are more beneficial in that regard, because you may be taxed initially, but you're taxed on a much smaller amount, which means you're taxed less. But once you hit those big numbers, which is what you're shooting for, this is what you're working towards, to have a much larger number in your Roth IRA in 20 years compared to what you do now. Once you hit that bigger number, it's going to be tax free, so you get to pull that money out without any additional taxes, which is what you want, right? So I would say Roth IRAs are more beneficial in that regard. Another difference between the two is that 401ks have limited investment selection. So your 401k is controlled by your employer, right? That means your employer has a certain range of plans that are offered to you. That's usually through somebody like Fidelity or Vanguard, somebody like that. And they typically have all types of plans, right? So they have plans that mirror the S&P 500. They have plans that might mimic certain types of bonds. You might have plans for emerging markets, which are stocks from other countries that aren't as established as the U.S. Sometimes they grow faster, sometimes they don't. But I just say that to say that you don't get to pick the specific stocks, ETFs, or index funds that you have in your retirement account because it's controlled by your employer, right? But that's where the Roth IRA is a little bit better because you have a wide investment selection. So with the Roth IRA, you can invest in any stock, ETF, whatever you want, right? Because it's controlled by you. Now, some might say that with the 401k, you don't have to worry about the stress of picking your own stocks, but also that limits your upside, right? And it's really not that difficult to have a lot of growth in your retirement account. There are so many different options, so many different ETFs that are available that give you strong returns without having too much volatility. So I would say that that's not really relevant anymore. But the Roth IRA, another thing that a lot of people forget is when you put your money in a Roth IRA, it still has to be invested, right? So when you put your money in there, it's basically just sitting there like it was sitting in the savings account. You still have to actually put it in a certain stock, in a certain ETF, and a certain index fund. So be aware of that. Just because you add the money to your Roth IRA does not mean it's invested just yet. So always be aware of that. Another thing that applies to both of them is they both have 10% early withdrawal penalty. So this applies to both of them, right? So I'm going to move this. I'm going to have this over here too. Any gains that you make on either one of these accounts, if you take those gains out before you turn 59 and a half, that is the age requirement. You have to be at least 59 and a half before you take out any gains that you earn on either one of these accounts, right? Anything you take out before that age is subject to a 10% early withdrawal penalty, right? So let's say over 5 years, you made $20,000 in gains, right? If you take out anything from that $20,000, it will be subject to a 10% penalty. So let's say you took out $10K, you had to pay a $1,000 penalty for taking that money out early. Now, where a Roth IRA has a benefit is that you can withdraw your contributions at any time. Can with you can withdraw your contributions. So you can add up to $7K to your Roth IRA per year, right? So let's say over 3 years, you max it out, you add $21,000. If something comes up where you have to cover a medical expense for your parents or yourself, or anything comes up where you need a little bit of extra money, you can take up to that $21,000 out of your Roth IRA with no penalty. Now, any gains you make on top of that $21,000 cannot be touched. That is what's subject to the penalty. But anything that you add yourself, anything that you have added from your own account that goes into this Roth IRA can be accessed at any time. So Roth IRAs are a little bit more flexible than 401ks. And one downside of Roth IRA is that it has an income limit, right? So the income limit is $146,000. So once you hit income limit at $146,000. So once you hit $146,000, you can no longer add to your Roth IRA. So Roth IRAs are better suited for people that are fresh out of college. You're getting your first job, typically early 20s to mid to late 20s, before you start hitting those big numbers, because it grows tax free. They had to add limits on how much you can add to it and when you can add to it, right? So if you're trying to decide between which one that you have, actually, I forgot one more piece of a 401k is that it has employer matching. Basically, your employer, and I'm pretty sure most, if not all, employers do this. Employers will match a certain percentage of your contributions to your 401k. Typically, that's anywhere between 3 and 6%. I would say 4% is about the average. Where whatever you add, they'll usually match up to 4% of this number, right? So if you can add up to 23,000, if you add 4% of that, they'll also add 4%, right? So it's essentially free money. If you have a 401k offered through your employer, I would say at bare minimum, you should add the employer matching amount so you can get that free money. So if the employer matching is 4%, every year you should add at least 4% of this value to your 401k. That way you get that free money. And then anything else you can add to your Roth IRA, right? That way, one, you get free money, you're adding money to your 401k, you have some of that on the side, but you also get to take advantage of this tax-free growth on your Roth IRA, and you don't have to pay any tax once you withdraw some of that money when you retire. So the solution is to own both, right? It's not an and or. Both are beneficial. Both have pros and cons, but owning both gives you the maximum amount of retirement benefit, right? Now there is a third option that not many people know about, but it kind of gives you the best of both worlds. And typically, you have to ask for it. It's not something that your employer will give you automatically, but there is something called a Roth 401k. It's basically a 401k that has the same tax-free growth treatment as a Roth IRA, right? So you still have the 23k limit. You still cannot take out any gains or contributions, right? You still can't take the money out, but you get tax-free growth. I highly encourage you to ask your employer if this is offered through the plans that they have. I'm pretty sure most have it, but you have to ask for it. Ask if a Roth 401k is an option, and if so, I highly recommend that everybody switch to it. It's still a 401k, but you get the benefits of a 401k with the benefits of a Roth IRA all in one, right? And you want that tax-free growth. This is very important. Taxes always eat away at wealth. You worked hard for your money, right? You worked hard for those gains that you accrued in your account over time. So once it's time for you to take them out, you don't want to have to pay anything extra, right? You've already paid with your hard work. You've already paid with your time. You've already paid with your health, right? So once you had to take this money out, you don't want to have to pay anything else, which is why a Roth 401k is the best of both worlds, right? So that is retirement accounts. Next, we're going to get into taxable accounts. So a taxable account is just a regular or brokerage account, right? So there are no limits. You can add as much as you want to them, right? So there is no cap on how much money you can add to it, right? Now, there is limited tax benefits, right? Limited tax benefits. So unlike a 401k where your money doesn't get taxed until you take it out, unlike a Roth IRA where it gets taxed first, but it's tax free when you take it out, anything you make in a taxable account is taxed at some point. Now, the benefit is when you take it out, right? So you have two tax rates. You have a short-term tax rate that is 20%, right? But then you have a long-term tax rate, which is 15%. And this is longer than 1 year. So if you hold your investments for longer than a year, specifically at least a year and 1 day, that extra day is important. If you hold your investments for at least a year, you're only going to be taxed at 15% compared to 20%. Now, this 5% doesn't seem like a big deal until you start hitting those large numbers, right? So let's say in a single year, you made $100,000 in gains, right? Which is very possible. Once you start hitting those big numbers, you can do that. If you made $100,000 and you sold it within 1 year, you would have to pay $20,000 in taxes, right? If you had held that for at least a year and then you earned $100,000, you would only have to pay $15,000 in taxes. $5,000 that's a big difference. That's an additional investment you can make to make additional money. So it's very important that you hold your investments for at least a year. We're hoping for long-term compounding gains, not just quick dollars. So you want to hold your investments for at least a year, right? Now, another benefit of taxable accounts is something called tax loss harvesting. And this is where investing really shines. And this is what the rich people do. So, tax loss harvesting. So I want y'all to write this down, right? Tax loss harvesting is when if you do lose money on any of your investments, you can sell those investments for a loss, and then next year on your tax return, you have two options. You can either defer those losses to a future year. So that let's give an example, right? Let's say year 1, right? You lose $2,000, right? $2,000 loss. And then let's say in year 2, you make $4,000. This $4,000 is going to get taxed, right? But because you lost $2,000 the first year, now you can reduce your taxable income by that loss amount. So if you have $4,000 and a $2,000 loss in the year before, only $2,000 gets taxed. So basically, losses aren't always bad, right? Because you can eventually have this reduce your taxable income. You still have $4,000 in your hand, right? You made $4,000, but this entire $4,000 is not going to get taxed. So now you only have to pay taxes on $2,000. And this is what rich people do, right? They sell their losses. Eventually when they do have those big years where they make buku money, they have those losses to reduce their taxable income. And that way they get to keep more of that money that they made that year, right? Now, also option 2, instead of putting it towards your gains from the following year, you can put that towards your tax return. So again, let's say you lost $2,000 in year 1, right? And let's say your taxable income is, I don't know, $60,000. Let's say your taxable income is $60,000, right? You can reduce your taxable income by this loss. So now you're only taxed on $58,000. Make that a little bit more legible for y'all. $58,000. So let's say this year you owe $2,000 in taxes. This loss will reduce that, and now you owe nothing. Or let's say you owe $1,000 in taxes, and you had this 2K loss from the previous year, you can then move that to your taxable income, and now you get a $1,000 refund. So essentially, even when you lose on investments, you never really lose, right? So if you have a loss, this can contribute to you getting a tax refund the next year. You'll get some of that money back, which you can then put back into your investment account and make some of that money back on another investment that does even better, right? Or you can use your losses for 1 year to reduce your gains from a previous year where you hit big. And that is how you keep recycling your money and keep that money growing over time. So this is something that's important. This is why investing is so important, because there's no other vehicle but the stock market. Real estate has its own type of tax loss harvesting, but real estate has a much higher barrier to entry compared to stocks. Stocks, you get that benefit immediately. So you have the benefit of not losing on your account even when you do lose. So always be aware of that. Tax loss harvesting is a huge benefit of investing in stocks, right? And last but certainly not least, let's get into brokerages. All right. There are a bunch of types of brokerages, right? Today we're going to be talking about 5, right? I don't want to overload y'all with information. I want to focus on 5 that are basically universal, that you can use for any type of purpose, and also nail down which ones are better for certain use cases, right? So let's talk about retirement accounts first. Retirement accounts, off the bat, I have 2. Retirement accounts. So retirement accounts, we have Fidelity, and we have Charles Schwab. Now, why did I choose these 2? Fidelity and Charles Schwab are what are called full service brokers. That means that you can call a number and there is somebody on the other line that can talk to you to help you with any issues you may have. Whether that's issues about your account, you can get connected to an advisor if you want somebody to help you manage your account or manage your account for you. Fidelity and Charles Schwab are great when you have your retirement account, when you want a brokerage that is considered that you never have to worry about. I mean, most brokerages are pretty secure, but these 2 are very reputable in the industry. Fidelity and Charles Schwab are great for retirement accounts. So, this is where your Roth IRA could go. Fidelity is great for that. Another benefit is that Fidelity has it's great for your cash that's just sitting there, right? So in most investment accounts, if you add your money to the account and it's not actually invested in a stock or ETF, it's just sitting there, not really accruing any value. Some are starting to offer more cash accounts, but Fidelity has the highest interest rate that you can earn on your cash. It's typically about like 4%, which is about on par, actually a little bit more than the high yield savings account. So you can have your money sitting there in this account accruing interest just like it would a high savings account, and then once you're ready to invest, instead of having to move that money over, you can just add it right then and there. So Fidelity is great. Each of these both also have great educational resources. If you are a beginner investor and you're looking to learn more, Fidelity and Charles Schwab have a great library of investment videos to teach you from the ground up. So both of those are great for first accounts and retirement accounts. I would say, so I'm going to say retirement accounts and first accounts. Now, you can open a Roth IRA with either one of these, and you can open a taxable brokerage account with either one of these, right? You can't go wrong with either one. Now, if you want something a little bit more flexible, if you are just looking for a taxable account, let's say you already have your Roth IRA with Fidelity or Charles Schwab, both of those are still good options for a taxable account. But some that are a little bit more catered to that and a little bit more flexible are so taxable account. I'm going to say E-Trade. I'm going to say Webull. And lastly, I really don't like this last one. I'm gonna put it anyway just because it's so popular. I'm gonna say Robinhood. And I'll explain why I don't like Robinhood compared to the other ones. So E-Trade. E-Trade is great, very advanced. It's good for charting. It's good for just, long-term investing. It's good for trading as well. E-Trade is kind of like a one-stop shop, right? So if you want an investment account that does it all, I would highly recommend E-Trade. One downside to E-Trade, it has no partial shares, right? Meaning you can't add $20 into a stock here, $50 there, another $10 here. You have to add the whole amount. It only has fractional shares is what it's called. That's the official term. It only has fractional shares for ETFs. So if you wanted to invest in SPY, which is an S&P 500 ETF, you could say add $20, $30 here and there. But you don't have to invest the entire amount. But if you're trying to invest in a specific stock like Apple, you can't. You have to buy the whole share at once. So that's one downside. Now, Webull is very beginner friendly, very simple interface. I use Webull personally. I've had a Webull account for 2 years now. I'm looking to upgrade to E-Trade, but Webull has everything that you can need from an account. And also, when you add your account, it's available. When you add your money to this account, it's available immediately. So that's another benefit of Webull. Very beginner friendly. If you are just opening your first account, Webull is very, very good. And then lastly, Robinhood. Robinhood is still a good account, right? If you're opening your first account, I'm not mad at it. Like, it's not a bad idea. The reason I don't like Robinhood is because they have this gamification element, and now they're starting to tiptoe more into gambling. They're calling it selection markets. It's gambling. And I feel like seeing those things available kind of creates bad habits, right? It's just like getting on Instagram and seeing somebody hit a 15-leg parlay. It makes you think, I could do that. The odds are slim, right? The odds of them hitting that 15-1 parlay are slim. So I don't want you to get enticed. I would prefer you choose one of these more official ones: E-Trade, Webull, Fidelity, Charles Schwab, because they don't have that additional gambling element to it to create those bad habits for you. But any of these five that I just mentioned are good. So I'm going to put all five back up again. E-Trade, Webull, Robinhood, Fidelity, and Charles Schwab. All five of these are great brokerages to open your first account. Now, what type of account should you have? I mentioned about the retirement accounts that you should have both, right? You should have a 401k and a Roth IRA, right? But everybody should have a taxable brokerage account. You should have all three. Why? This will be my last point for the day. Retirement accounts are for 20 plus years, right? This is money that when you're old and you can't work no more, this is what you draw from, right? Taxable accounts are for 3 to 10 years. So this is what you use when you're saving to start a business, when you're saving to buy a house, when you're saving to go back to grad school or a PhD program. Taxable accounts are I like to think of them as a higher yield savings account, right? So where a high yield savings account, you might get anywhere between 3 to 5%, right? 3% on the low end, 5% on the high end when rates are high like they have been for the past couple of years, right? 3 to 5%, it's not really moving the needle. It's kind of just like, it's a good return, but it's not great, right? Your taxable account, the S&P 500 has earned an average of 10% per year for the past 100 years, right? So you're doubling, almost tripling your return in your taxable account over a long period of time, which is why I say 3 to 10 years, because that's the average return over the course of that time. 1 year, you might make 20%. One year you might be down 5%, another year you might make 25%, right? But over that long period of time, it'll probably average out to around 10 to 12%. So this is your nest egg for the midterm, right? This is for your more immediate goals compared to, you don't want to be stuck to just having a large sum of money in your retirement accounts you can't touch for the next 30 years, right? You want to still have access to some money that still grows over time, and you do it through this taxable account, right? So just to recap everything we talked about today, we talked about the difference between a 401k and a Roth IRA. We talked about an account that gives you the best of both worlds, which is a Roth 401k. Definitely ask your employer about that. It is very beneficial. It gives you the best of both worlds. We talked about the benefits of a taxable account and what it's for. Your taxable account is for midterm goals, usually 3 to 10 years. If you're looking for going back to school, owning a house, starting a business, things like that, that is what a taxable account is for. Still have growth, but you still have access to your money. And then we talked about some brokerages, and I gave y'all 5 options. My top 4 are Fidelity, Charles Schwab, E-Trade, and Webull. And I'm going to have Robinhood as an honorable mention just because it is very easy to use. It has a very simple interface, but it's not my personal favorite. That wraps it up, y'all. This concludes week 2 of Whiteboard Wednesdays. Make sure y'all check out next week, where I'm going to be breaking down different types of assets, stocks, ETFs, crypto, and so forth. Stay informed, stay invested. I'm going to catch y'all next time. Peace.